Okay, this is the first of the calculation sections that we need to look at in terms of workings. If you've gone and you've looked at past papers, you'll see that they always give you questions regarding taxable income and calculating taxable liability for businesses based on information that's given in the question. So if you're looking specifically at tax, you obviously need to identify the taxpayer first. And this is something we looked at last time. Well, when I say last time, when we covered theory. When we looked at Learning Unit 3, we spoke about sole proprietors, partnerships, closed corporations, and companies. How does a sole proprietor get taxed? Do you remember?
Like you mean the owner? The owner is the business, so the owner gets taxed.
Correct. Yes, the owner has to pay tax in their personal liability, personal capacity, and they'll have their own liability. Does that make sense?
Yes.
Okay, so they're taxed as an individual. How do partners get taxed?
Each partner would get taxed.
Correct. Same as the sole proprietor, as an individual. Right, so every partner, if you're in a partnership and you have, let's say, 5 partners running a business, every single partner would have to submit their own return to SARS and they would have to file their tax return with SARS as an individual, not as a business. Remember, a partnership isn't recognized as a separate legal entity. So that's why sole proprietors and partnerships are taxed like individuals, okay, in terms of every single person, okay, would have their own tax that they would have to pay to make sure that they comply with SARS's rules and laws. Does that apply to a closed corporation and a company, both public and private?
No.
Okay, what's special about this separate legal entity status? What benefit do those businesses have?
Uh, the business is seen on its own as a
Correct, yes. And from a member's point of view or from a shareholder's point of view, remember there's limited liability.
yes.
Okay. So when you're dealing with CCs and companies, because they have separate legal entity status, they're a separate taxpayer. So they pay their own taxes. You've got to submit a return on behalf of the company or the CC, public, private, whatever it is. Okay, so because it's a separate legal entity, it's taxed as its own individual. Okay, they call that a juristic person. It's not writing that down. Juristic. 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 Okay, juristic person. Right, so a business, sole proprietor, partnership doesn't exist on its own. Okay, there's no juristic person. Closed corporation company, that does exist, that does apply. Okay, and then obviously the last time we also spoke about classifications. Okay, so CCs and companies, okay, not really the public ones, but more the private ones. All right, because private companies can be very small, they can be grouped into those two categories. Right, SBC or micro. Right, if it's micro, then they get taxed according to turnover. If it's an SBC, they get certain benefits, which we'll learn about later. One of the benefits would obviously be a progressive tax system. Okay, so they're taxed according to a scale rather than a flat rate. Okay, turnover just taxed on sales basically. Okay, but then no deductions. Right, so here's your checklist for SBCs and micro. Right, when you're looking at any question, and I've seen past paper questions where they've actually asked students to comment and discuss if a business would be recognized as an SBC or a micro. Okay, those are obviously written past papers from before. More recently, obviously, things have gone online, so I'm not too sure how they're going to test this in terms of theory. It'll probably be in a multiple choice, but we'll have to wait and see. Right, if it's a multiple choice, then you just need to choose the correct answer, which is a bit better. So something to highlight here in terms of the checklist. Okay, this checklist actually comes from one of the activities from a previous section, okay, in one of the years where I've hosted this course. And this is a really good summary summarizing everything that you need to look out for. Okay, it's important to also note that you have to meet all the requirements. If you miss one of them, you cannot be classified as an SBC or a micro business. So it's either you meet all, okay, or you don't meet any. Okay, if you miss one, then sorry for you, you're not an SBC or a micro business. Okay, the requirements are quite strict. Okay, and the reason why they're strict is because these types of businesses have a lot to gain in terms of benefits. Okay, SBCs get accelerated write-offs in terms of their capital allowances, which you don't know yet. There was a question about that in the actual assignment, the one that we did some weeks back, okay, when we had the last live session. Micro businesses, obviously, less admin. Okay, they don't have to keep documentation, they don't have to track their expenses, they literally just need to keep track of their sales because turnover is how they're going to be taxed. Same with SBC, okay, they can also apply certain benefits in terms of a sliding scale rather than a normal company. Right, so you have to meet all these requirements. The checklist must be complete. Right, so SBC and micro must be natural. Okay, shareholders must be natural. Shareholders are people that own equity in the business. Don't hold shares, okay? None. So in other words, they cannot hold shares, right, in other companies, okay? There are certain, let's say, exceptions to the rule, and those are quite specific, right? But ideally, they shouldn't hold any equity in any other company. Right, the gross income or the turnover must be less than 20 for an SBC and less than 1 million for a micro. Investment income, there mustn't be any. Okay, no investment income for the SBC or the micro. Private company, yes, that can apply to both, right? So it must be a private company. And then year end, any year end for SBC, and then for a micro, it must be the same as an individual. What's the year end for individual? Do you remember?
28 Feb.
Yes. Okay, 28 or 29, depending on whether it's a leap year. February, every year, that's the tax year for an individual. So micro, if the tax year is not the same, and this one's out, you cannot be considered micro. Okay, so you need to tick all those boxes before you can use those benefits. Right, so we've actually looked at this before, so I'm not going to spend too much time covering this because we looked at it when it was more recent. Obviously, some weeks have passed since the last budget speech, but just to talk about the good, the bad, and the ugly. Remember, every single year there's a budget speech, and that budget speech is going to highlight the tax rules, okay, for the next financial year or tax year. So in other words, 1 March 2021 to 28/29 Feb, okay, 2022. Right, so that's what they presented on in February, okay, because remember February 2021, that's just before the next tax year. Right, so government announces all those rules for the next tax year because those tax rules apply to the current tax year, right? So the current tax year that we're living in, obviously all those rules that were announced in February will apply to the whole country for the period 1 March to 28/29 Feb. Right, does that make sense? Are you okay with that? Yeah, okay, just remember, I know that you thought the corporate tax rate had decreased, but that was something that they were discussing. Right, remember, tax rules have to be, they have to be, let's say, set in stone. Okay, so in other words, they have to agree on those rules before they can be implemented. So just be careful. Always use those budget pocket guides. Okay, so this is the one that you're going to be using for this year. Okay, obviously this was announced last year, February. Okay, February 2020, they would have announced all of these rules. Okay, obviously the tax year has concluded. Right, so businesses that have operated up until the end of Feb 2021, they're going to be using all of this information when adhering to and complying with all the tax rules regarding their operations, their income, etc. Okay, so we're always going to be using last year's rules in the current year because it's done retrospectively. Okay, you're looking at last year, you're looking at what happens. Okay, does that make sense?
Yes.
Okay, perfect. All right, let's go back. In Learning Unit 4, Study Unit 4, we're going to be focusing on income. Okay, remember when we covered the basic tax liability calculation or taxable income, remember, taxable income is calculated first. Once you've got the taxable income, then you work out the tax liability. Okay, you'll see that breakdown later on in the notes. I'm just trying to revise and remember some important concepts. Okay, before we get taxable income, okay, right at the top of the calculation, you've got something called gross income, right? And this is exactly what you're looking at. Okay, so I spoke about this previously. When you go through the different units, okay, the later units, the units that are coming up now, okay, you're basically looking at line items on that actual calculation, right? So when you work out taxable income, the first line item is obviously gross income, and that's exactly what we're looking at, right? So when looking at study unit 4, just remember that income is the focus. We're not looking at anything other than income. What is income? Do you remember what income is from accounting?
Right there. It's an inflow.
Correct, yeah. It's any benefit. It's basically something that's coming into the business. So sales, services rendered, rent income, any form of benefit that the business is going to derive. So an individual or a company can obviously render a service. Will tax be paid on that income?
No.
Renders a service, of course, yes.
Yes.
Okay, remember, all income is going to
But
be
don't you also have
taxable.
allowances?
Yeah, but you see, that's something different. An allowance or a deduction will be taken off the gross income to get the taxable income. But if we're just looking at income, income is income. All income is taxable. Some income is exempt, some income is omitted or left out because of certain rules, okay, or deductions or exemptions. But if I'm just focusing on income, every little bit of income will be included or taxable. Okay, taxable, but not necessarily taxed. Does that make sense?
Yes.
Okay, so it'll always be included. So when you're submitting a return, okay, the gross income is literally everything. SARS wants to see everything. Okay, even the income that is exempt. Okay, so maybe just to talk about an individual, just for a minute. This isn't covered in the module, but obviously dividend income is something that individuals can earn from different shares. Okay, and if you hold shares in a South African company, SA companies, right, those dividends that you get are actually exempt. Okay, because they've already been taxed. Right, the company gets taxed and then you pay dividend tax. So for them to tax it again would be unfair. Right, and they don't do that. So in South Africa, right, any dividend income, you still have to show it though. Right, so you still have to tell SARS, okay, SARS, this is how much I got, dividend income, but according to the rules, it's all exempt. Right, so it doesn't matter how much dividend income you're getting. It can be a few hundred rand, it could be a few thousand rand, it can be a few million rand, it doesn't matter. The point is, you have to show it. Okay, you have to tell SARS, this is how much dividend income has been earned because it's the gross income, it's everything. And then obviously, if it's a South African company, it'll be exempt. But an individual, a company disposes of a non-current asset. Will they have to pay any tax on this income? Inverted commas.
Yes.
Okay, but will it be seen as income? So in other words, if I sell a building or if I sell a vehicle, if I sell a machine. Think back to your accounting. How do you view that?
It would be profit.
It'll be a disposal. In other words, it's a profit on sale, exactly. So SARS isn't going to include this as income, okay? It's something special. It's a taxable capital gain. Okay, that's why when we had that what I'm going to call it a template. Okay, when we had that template, you had gross income, then less deductions and allowances, and then you had add taxable capital gain. Okay, so a taxable capital gain is not purely income, it's seen as income. It's taxable, but it's included as a separate line item. It's not considered gross income. Okay, so the point with this slide is that if you're rendering a service, you're operating. Okay, operations is different to selling off assets. Okay, asset disposals. Right, asset disposals in accounting are treated differently to sales and services rendered. Do you agree?
Yes.
Okay, so is there a difference between the two transactions? Yes. What's the difference?
Operating would be income, and then if you dispose of an asset, it will be capital gains.
Yeah, so this will be capital in nature, and this will be non-capital in nature. Okay, so this is what tax uses to describe it. Okay, so non-capital type transactions, okay, are seen as income. Capital type transactions will be seen as capital gain. Okay, that's just the classification. So it just depends on the focus. In other words, what are you actually doing? Are you selling goods, okay, that you're producing, or are you selling the actual machines that are producing the goods? Does that make sense? Okay, later on you'll see a discussion about a tree and fruit principle. We're getting there. Okay. Sorry, wrong way, down. There we go. Okay, on the next slide, can we get different types of income?
Yes.
Okay. Will all income be taxed the same?
No.
Okay, because remember, income has to follow certain rules. Okay, sometimes that form of income will be taxed differently. Okay, but it's still gross income. So, for example, going back to that example, dividend income. Okay, that's income. I need to show it as part of gross income if I'm an individual. Okay, if I'm an individual and I'm earning dividend income, I'm going to show that as part of my gross income. But will it be taxed the same? No. Okay, dividend income is taxed according to a withholding tax on dividends. Okay, we saw that in one of the, actually, let me show it here quickly. There, dividends, okay, it's a withholding tax, 20%. All right, so obviously, if you are receiving dividends, okay, and it's from a South African company, those dividends are exempt, only subject to dividend tax. Okay, because obviously those dividends have already been taxed within the company. Because what is a dividend? It's a payout of profits. Okay, so the company would have paid out profit, okay, a portion of the profit on the profit that they've created or generated, and then a portion of that is then going to be paid out to their shareholders. So the dividends is already taxed 20%. Okay, so there's an additional tax on those payouts, and then obviously whatever's paid out won't be taxed further, right? And that's exactly what we're looking at here. Okay, so obviously different types of income will be taxed differently, and also something else to remember is if you're a resident versus a non-resident. Okay, the way things are taxed, the way income is taxed is also different. Okay, we know that a resident is taxed on what basis?
You're not living in the country.
No, if it's a resident, it's worldwide.
Oh.
Okay, so if you're a South African in the country and you earn income from another country, you need to pay tax on it in this country. Does that make sense?
Yes.
Okay, if you're a non-resident, then it's only SA source. Okay, so you're a USA, okay, citizen, but you come to South Africa to do maybe a week of contract work. Okay, because that work was in South Africa, okay, that US resident would be considered a non-resident, and they would only pay tax on that portion, the 7 days income that they earned, not on all the other income they have in the USA or other places. But if you're a resident of South Africa, they don't care. They tax you on everything. Does that make sense?
Yes.
Okay. So how do we know what income is?
If it's an inflow,
Okay, there's a rule. Okay, SARS. Right, Income Tax Act. Okay, the Income Tax Act will give us a definition of income. All right, so before we look at that, there's the note about resident versus non-resident. How do you determine if a person is a resident or a non-resident? Any idea?
I remember there was a requirement, but it's how long you live in a country.
Okay, that's part of it, but only for individuals. Okay, can a company move from one country to another?
Yes.
Well, it depends on their head office, but obviously, if a company is created in a certain country, their head office will be, they call it domiciled in a specific place. Does that make sense?
Yes.
Okay, so if I'm looking at a person, we need to differentiate between a natural person and a juristic person. Obviously, a natural person, you can have what we spoke about previously, a physical presence test, okay, and that will be applied depending on how long they stay in the country, right? But if it's juristic, it's more related to this, okay, the effective management. Okay, this is where the theory comes in. Okay, I didn't write anything here, but I'm just going to put a note here, NB. Okay. I'm going to use the words. They talk about where you return, okay, or they talk about like the main place of control or management. Okay, so if you're an individual, right, you can be an individual and you travel the world. Okay, and you're hardly in South Africa, but you love the country so much that you will always consider South Africa as your home. Okay, then they call that a natural person. Okay, and because it's your choice, you've chosen to be a resident of the country, right? Then obviously you're going to pay tax, right? But obviously people would apply the physical presence test because it's going to help them reduce their taxes. Okay, so even though you love the country so much, obviously if you're out the country for a significant amount of time, you might be able to use the physical presence test to your benefit to reduce your taxable income, because then you'll be taxed like a non-resident rather than a resident. Okay, obviously residents have to pay more tax. Non-residents pay less tax. Okay, but it's a very specialized thing. It's something that SARS does look at quite carefully, because obviously very wealthy individuals can try use this to reduce their taxable income and to pay less tax in a specific country. Right, so they always look out for those. They call them tax dodgers. Okay, if you dodge tax, that's bad. Okay, eventually, if the law catches up with you, you're going to get penalized. Okay, either jail time or fines or both. Okay, depending on how severe the tax evasion is. Okay, remember, tax evasion is bad. Okay, there's nothing wrong with reducing your income tax as long as it's in line with the rule of law. Right. So, what do we need to look at? Companies. Right, so how is a company, okay, how is a company considered non-resident or resident? It's all got to do with incorporation and effective management. Okay, so the first thing that you need to discuss is, where was the company started? Okay, so here's a good example, Uber Eats, or just Uber in general. Okay, if you've ever used Uber, okay, I'm sure you realize that Uber is used in South Africa. Okay, but where was Uber created?
I think America.
Correct. Okay, it's a USA company, all right? Silicon Valley, right? One of those tech companies. Incorporation, Uber is a American company. So obviously they would have been incorporated or they would have been created in the USA. Okay? And the effective management will also be in the USA. Right, so Uber would be seen as a non resident taxpayer. So, in other words, Uber will only have to pay taxes, okay, on income that they get in South Africa. All right, so if you look at our country, I'm going to try to draw it. Okay, that's not a very good drawing, but okay, so in South Africa, anywhere in this country, okay, if Uber is operating anywhere in this country, okay, and they're making, let's just say 100 million plus minus whatever it is, okay, I don't know the details, I'm just going to use that as a figure, okay. Obviously they're going to have to pay taxes in South Africa, but only on their South African income. So they'll have to pay 28%, okay, because that's corporate tax in South Africa on the 100 million, right. Remember, Uber also operates in other countries around the world, in the US, in the UK, probably in lots of other countries. Okay? And they're going to be earning maybe billions of rands, okay? Maybe 100 billion, okay, because we're converting it from dollars to rands. Okay, in terms of the USA, maybe they're earning 100 billion rand in the USA. Is the South African government going to tax the 100 billion that's earned in the USA? No, they won't, because Uber would be considered a non-resident. So they don't tax it as a resident.
So say if we tax Uber the 28% here in South Africa, will they also be taxed in America?
Well, see, that comes to a double tax agreement. Okay, that's something we saw in a previous slide. Double tax agreements are agreements with agreements between countries. So you've got the USA and you've got SA. Okay, and obviously if you've got a company that operates in both, okay, there could be a double tax agreement in place that would prevent them from getting taxed twice. Okay, so if Uber is paying tax in South Africa, Uber will probably not pay tax in the US again. But remember, only on the South African revenue. Okay, obviously the US is going to tax Uber on their US income. Does that make sense?
Yes.
Yeah, but if they're taxing if the South African government is taxing Uber already in South Africa, and then Uber's going to take that money to the US. So if it's 100 million, 28 million, if I'm just looking at a flat rate, 72 million will be taken back to America. Does that make sense?
Yeah.
Okay, if that 72 million is taken back to America, that amount, in terms of the amount that was taxed already, most probably won't be taxed again in the US because it has already been taxed. Does that make sense? And that's called a double tax agreement. Yeah, that's very advanced and that isn't looked at all. It's just mentioned in the actual textbook in one of the chapters. We've looked at it before actually. I think it has come up already. Does it make sense?
Yeah.
Okay, so just remember, for a juristic person, what are you going to be looking for? Incorporation and effective management. Okay, let's assume Uber decides to move their head office from the US to South Africa. Okay, if they had to do that, then the South African government could say, well, incorporated, no. It wasn't incorporated in South Africa. But effective management, yes, it is in South Africa. So because there is a tick for the one, okay, SARS might say, well, because you've moved your head office to South Africa, they could potentially tax Uber on their worldwide income if they wanted to. But they're going to have to motivate why they're taxing Uber if Uber had their head office in South Africa. Right, remember head office. In other words, effective management, not a regional office. Obviously, Uber can have a regional office, and that's just an office where they basically run operations from in the country, but it's not their head office, right? But see that makes it very questionable. Okay, and that's where you get cases. Remember we spoke about case law.
Yeah.
Okay, some big corporates can take SARS to court, and if they take SARS to court, there'll be a judgment, and then there'll be a case that will be used as precedent in future cases. Does that make sense?
Yeah.
Okay, and that's kind of what we're looking at here, but obviously at a very, very basic level. Right, so on the next slide, a resident versus a non resident. A resident, in terms of natural, notice natural persons. In other words, you and I, individuals, real people, not company people. Okay, because it's persons. Okay, so you get a juristic and you get a natural. If it's natural, you have an ordinarily resident test. Okay, ordinarily resident means what I said about what I spoke about earlier. Okay, where will you naturally return from his or her wandering? See, there's the wording that I was looking for earlier. Okay, so you can travel the world, but you will always return to South Africa because you love the country. Okay, the individual would naturally return from his or her wanderings. Okay, if you're always coming back to South Africa, then they're going to say, well, you're considered a resident. Okay, does that make sense?
Yeah.
Okay, if you're not an ordinarily resident, okay, then they're going to apply the physical presence test. They're going to look at how long you were in the country. Okay, you're not an ordinary resident, okay, but then you need to apply the the physical presence test, and then they look at, I think it's 183 days. Okay, it's been a while since I've looked at that, but you can maybe Google and search for more information about it, but you don't need to know that. Okay, but they look at 183 days as a criteria or a checklist, okay, in terms of time that you've spent in the country. Okay, but yeah, not necessary for this course. This is important though. Okay, natural, not so important. Juristic, very important. Okay, because they're going to test you on companies. Okay, so juristic person. Okay, juristic person, how are they taxed? Effective management. Okay, so what determines effective management? Everything that I've underlined in bold. Okay, and see, these are things that you would discuss in a essay question. Okay, in the past, I've seen questions like 10 marks, 5 marks, 6 marks. Okay, and those questions deal with this concept. Okay, and then you would discuss it. Then you would bring all these points, and then you would discuss it, and then you would say, this company is not a resident, or this company is a resident. Okay, the first bullet point, SARS will say, the place where the company is managed on a regular day-to-day basis. In other words, where do the directors, senior managers, all of them exercise their decision making? Is it done overseas? So if we look at Uber, obviously in America. Okay, that in America, the USA, okay, obviously they run how the company is operating across the world. Okay, another point, day-to-day operational management. Right, something else to consider. Another thing to consider, business operations activities, okay, conducted and carried out from, right? And another thing, the strongest economic nexus, right? So how big does that, or how much revenue does that company make in a particular country, right? So you've got USA, you've got SA, you've got UK, you've got other places, okay? Obviously, Uber probably makes the most in the US because that's where they started. So strongest economic nexus, the USA. Okay, even if they move their head office to South Africa, right, it might be questionable in terms of SARS wanting to tax them as a resident. Okay, in other words, tax Uber on all their revenue across the world. Okay, I mean, the South African government would be very, very happy with that. Taxing Uber on the billions that they make across the world, and then it all goes to the South African government. Does that make sense? Okay. All right, so there's that slide that I was talking about earlier. All right, so this whole set of notes, this week's content, everything is going to be focusing on income. Okay, remember we said income is something that you have to determine because it's going to be affected by deductions, capital gains, and then ultimately you want the taxable income. So just because it's income doesn't mean it's taxable. All right, income can be reduced by deductions, allowances, exemptions, etc. to get taxable income. Taxable income is what SARS will actually tax you on. Does it make sense?
Yeah.
Okay, but they want to know everything. So they're going to want to know what all the income is, right? Because that's just part of the process. You have to disclose all that information and then apply this, apply this, apply this, and then get that. Does it make sense?
Yeah.
Okay, so residence. We spoke about this. There's the slide. Worldwide income. Non-residents. Taxed on income received from South Africa, including deemed SA income. Okay, what does deemed mean? Do you know?
Uh, I don't know how to explain it. It must be like what you show in a way.
Yeah, kind of. So deemed to be, it's kind of like assumed to be, or like
Yeah,
it's deemed to be. It's like it's yeah, it's assumed to be, or it's considered to be, that type of thing. Does it make sense?
yeah,
Okay, so it doesn't even have to be in South Africa as long as it's deemed to be a South African income. Okay, and this is where it gets a little bit, how can I put it? Questionable. Okay, and that's why you get certain companies going to court. Okay, that's why we have so many cases. Because sometimes SARS might say, well, it's deemed to be an SA income, and then SARS is going to want to tax it. But then the company is obviously going to say, no, I don't agree, I don't want you to tax it. And then it gets taken to court, and then the courts make it a judgment. Do you see how everything fits together?
yeah,
Okay, because you know how the courts are structured. You know how the disputes are handled. Okay, obviously disputes go through a dispute resolution process. Okay, if it gets to the courts, then the courts rule on those matters. Okay, so sometimes companies, the PTY Ltd, can disagree with SARS and they can say, no, it's not fair. I don't agree with your assessment. Okay, you're telling me I need to pay you so much tax on my income from my company. I don't agree. Okay, they dispute it. SARS says, no, we're going to stand by what we say and we're not going to allow you to deduct or to do whatever they want. Okay, and the company also is standing firm and saying, well, they're not going to budge. So they're both not going to budge. Then what must they do? Take it to court, let the courts decide. Okay, and that's where you get all those cases. Okay, that's why you'll see like a name versus CIR, Commissioner of Inland Revenue, or the Commissioner or the I think SIR. That's also another one. All right, so if you've ever looked at cases, you'll see some of them in your textbook actually. You'll see some in the study guide as well even. It's basically someone. Okay, it could be an individual. Okay, individuals can also take SARS to court. Okay, companies can take SARS to court. All right, as long as you've got the resources, as long as you believe firmly that you're correct and they disagree with you, then sometimes you have to have the courts to step in, okay, and to make a judgment. All right, sources of income, income cause, and location of the cause. All right, so when you're looking at the source, they're going to determine, well, what caused the income, okay, and where is the location of that cause. So in other words, where did it arise? Okay, where does that income arise? That's important. Okay, was the income created in South Africa or was the income created outside of South Africa? Right, does that make sense?
Not really. Can you explain that?
Okay, so let's assume you are flying an aeroplane, okay, and you're going to be traveling to different places around the world, okay? Income cause, all right, so as a pilot, okay, what's the cause of the income?
Flying.
Yes, okay, so being on the plane and flying the plane around the world. Okay, but if you have a flight from Orar Tambo to, let's say, Brazil, okay, all right, what was the income cause? So it's the flight from the country to that country. Does that make sense?
Yeah.
So if you're a pilot, you can't say, well, I was on the plane and I was in Brazil, and let's assume you're flying in Brazil and then you fly around Brazil, whatever, and it takes up a lot of time. Okay. And then you're saying, well, in terms of income, okay, what caused the income? Well, you're flying. Okay, you're flying, you're piloting the plane. The location of the cause would be, well, which airline do you fly with? Okay, if you fly with SAA, obviously they're going to say, well, the income in terms of what is derived is coming from SAA. SAA is a South African company. SAA is not a Brazilian company. So you can't say, well, I was flying in Brazil, so a part of my income is Brazilian income and a part of my income is African income. They're going to say, no, sorry for you. Okay, what caused the income? Well, you're a South African pilot. Okay, it doesn't matter where you are in the world, you're still a South African pilot. If you can fly to all those other countries. Okay, the cause was the flight from South Africa to all those other places. The location of the cause, in other words, it was created in South Africa. SAA is the location of the cause. You just so happen to fly to different countries. It's the same with contractors. Okay, maybe you're a contractor or you're a what do they call them? Yeah, contractor. Those people that work for different companies or consultants. That's it. Not a contractor. I was looking for the word consultant. Okay, you're a consultant, and then you consult. You consult in America. You consult in Europe. You consult in Asia. You consult in Australia. You consult in South America. Right, but you're a consultant, and the company is based in South Africa. So you can't say, okay, because I consulted in America, it's American income. Well, I consulted in Europe, and it's European income. Okay, they're going to say, well, okay, you were employed by a South African company, so the location of the cause and the income of the cause is in South Africa.
What happens if you work for a consulting company and you live in South Africa, but the company is American?
Yeah, then that's different. Okay, because now you're not a South African, so then it'll just be the other way. So now you're an American. Okay, you work for an American company, Uber. Okay, you come to South Africa and you work in this country at the Uber regional office. Okay, but you don't work there permanently, okay, because you're just here for a few weeks or a few months even. Okay, obviously, because it's an individual, okay, then they're going to apply that whole physical presence test thing, natural persons test thing, okay. But if it's a company, right, a company can have different businesses around the world, little offices, okay, but income cause, okay, location cause, that's always going to be the source of income. Okay, so if you are a consultant, let's say you're a consulting company from America, okay, the source of the income is, where did the income come from? Okay, did you get a client? Is the client in the US and then the client has offices around the world? Or did you have a client in Brazil and that's where the client is, and that's where you source the client. Then SARS could say, well, okay, the source of the income is probably Brazilian because it's a Brazilian client. It's not an American client that has offices around the world. So this is where it gets questionable, and that's why you have cases. Because SARS will say, I want to tax all of that in South Africa. And you're going to say, no, I don't want to tax all of it in South Africa because why must I pay 28% tax on money that I earned in another country? Does that make sense?
Yeah.
And it's going to come down to this source of income. It's going to go to the courts. Okay, the judge is going to decide based on the facts. Okay, then the company is going to put their evidence together. What do they call it? The plaintiff and the defendants, they're going to put all their stuff together. Okay, the judge is going to hear the plaintiff, the judge is going to hear the defendant, and the judge is going to say, okay, you're right, you're wrong, and then that's just what they use. Okay, yeah, so that's why things go to court. Things go to court because there's disputes. People don't always agree, and when people don't agree, we need someone to mediate. Okay, so the courts decide, and the courts basically say what the final say is, and then everybody has to follow that. Okay, all right, but yeah, we're really digressing. You don't have to know as much detail. Okay, as long as you're just comfortable with source, okay, residence, and worldwide. Okay, worldwide is obviously resident, and then non-resident is South African source. Happy?
Yes.
Okay, step number 1. What am I looking at? Gross income. Remember, it's part of the taxable income. Is there a difference between taxable income and gross income? What's the difference?
Gross income is literally all of your salary that you get paid from a company.
Exactly.
And taxable income is your gross income minus your allowances and deductions.
Yes, good. Okay, yeah. So gross income is defined by the Income Tax Act. Okay, all of this stuff comes from the Income Tax Act. I've just taken the important bits out of it. Okay, so any person who is a resident, see, notice the word resident, total amount of income worldwide. Okay, they don't care where you are. Okay, as soon as they get you as a resident, once SARS gets you as a resident, they're smiling because then they're going to say, I don't care where you earn your money. Because you're a resident, I'm going to tax you on all your money from everywhere in the world. Does that make sense?
Yes.
Okay, I don't know if you watched the news yesterday, but on the news, they interviewed the SARS commissioner. And they were talking about super wealthy people. And they're going to be looking at clamping down on super wealthy people because super wealthy people have income that's worldwide. Okay, and a lot of them don't pay the right amount of tax or should be paying more, but they're paying less. Right? We'll assume that the super wealthy are law-abiding citizens. Okay, but not all of them. There could be a fraction of the super wealthy, maybe 1% that are like rotten eggs, okay, or rotten apples. Okay, those rotten apples are obviously South Africa as a country is losing out on a lot of tax from these super wealthy individuals that don't pay the right amount of tax according to the rules. Okay, so obviously we're going to assume that all of them are paying the right amount of tax, but that was something that they were talking about. They interviewed the commissioner, and they were talking about the different steps. Okay, they're actually going to ramp up their they call them audits. Okay, to check people's it's called a lifestyle audit. They're gonna do lifestyle audits on people, and they're going to check, are they complying with SARS's rule of law, okay, and are they paying the fair share of taxes. Okay, any person who is a non-resident, notice non-resident, now it's accrued to in the country, source within the country. Okay, so that's the difference. So gross income just means everything. All of it. All of it means worldwide if it's resident, or only South Africa if it's non-resident. Make sense?
Yeah.
This is very important to note. Okay? capital nature or not? Right, the 8th schedule deals with CGT, capital gains tax. Okay, that's a separate chapter. We'll get to it later on. I think that's the final learning unit. I think it's number 7 or number 8. Okay, that's the last one. Okay, we'll look at it later. But CGT is not income. Okay, it's not gross income. CGT is a capital gain or a capital loss. Capital means not income, something other than income. Okay, so not of a capital nature. Does that make sense? Okay, so if it is capital in nature, it must be taxed separately. Right, the second step is to apply the deductions and the allowances and the exemptions. Okay, exemptions are special. They're special concessions that the government has that will allow taxpayers to reduce their taxable income. Okay, remember, income minus all the stuff, taxable income. Right, so obviously if you've got exemptions or deductions or allowances, it's going to help you reduce your gross income to get your taxable income. Okay, it's basically describing what's in the in that formula. Okay, this thing here. Okay, we're basically describing this but in words. Make sense? Okay, right, the third step, what is the taxable income? Okay, that taxable income is going to be defined as, okay, after deducting any amounts, okay, and after including income and taxable amounts. Okay, so special inclusions. Things that must be included, like a taxable capital gain. Okay, taxable capital gain will be included in the taxable income of a taxpayer. All right, so how do we determine what is income? There's the definition. Okay, this is very, very important. This they always test. There's always theory questions on this. Again, I don't know how they're going to test it now because it's multiple choice, or maybe it's not. Maybe it will be written, but written online. Okay, we'll have to wait and see. But if you look at past papers, they always give you a theory question, maybe 5 marks, maybe 7 marks, and they ask you to describe and to discuss when something will be considered income. And then you've literally got to go through the process. You've got to look at each and every one of these things. Total amount, cash or otherwise, received by or accrued to, year of assessment, and excluding capital nature. All right, any exempt income, we spoke about exempt income, it's removed, meaning it's not part of taxable income. We also spoke about special inclusions. It's included, so it is part of taxable income. Okay, so special inclusions, there's quite a few, right? But the only one that you're going to be looking at is the taxable capital gain. Okay, subjective and objective tests are important. Right, what is a test? What does a test do? Yes, exactly. Okay, so subjective means there's room for interpretation. Does that make sense?
Yeah.
Objective means things that you cannot dispute. Okay, so an objective test could be something like, where was the invoice created? Was the invoice created in South Africa or was the invoice created in the USA? Okay, obviously, if you're operating in South Africa and the USA, right, there are invoices that apply to both countries. Does that make sense? That would be objective. Objective means you can't dispute the facts. Okay, the invoice was in South Africa or the invoice was in the US. Subjective is where it gets a little bit questionable because it's the interpretation. There's room for interpretation. Does that make sense? Okay, and when there's subjective tests, then we need to bring in the facts. Well, not really the facts, the evidence. Right, and then it's based on evidence. Okay, is it leaning towards this or is it leaning towards that? In other words, is it seen as capital or is it seen as income? What do you want it to be seen as a taxpayer? Do you want things to be seen as capital or do you want things to be seen as income? Which one do you think? Capital or income?
I think capital's lower.
Yes. Yeah, capital is always lower because they don't tax you according to the progressive tax scale. Taxable, if it's a capital gain, there's also other benefits as well. Okay, a portion of it is included, not all of it. So that's also something to consider. But yeah, ideally, if you were looking at something to be classified as income or capital, you always want it to be capital as a taxpayer. SARS would want it to be income because they're going to collect more tax from you. Does that make sense?
Yeah.
Okay, these are some of the cases that you're going to see in different discussions later on. Okay, case law is important because this adds to your discussion. In other words, it gives you more marks. Okay, this is like bonus marks. If you can bring in these discussions, if you can bring in these cases into the discussions, it normally impresses the marker, okay, because the marker is going to be looking out for some of these. Okay, the ones that are important for income. Right, for income, CIR, okay, the Commissioner of Inland Revenue versus Butcher Bros. Okay, that case talks about ascertaining the amount, cash or otherwise. Okay, so this is looking at a debate or a dispute when they were looking at if it's cash or if it's otherwise. Right, so in other words, when will SARS actually tax you? Will SARS tax you when you actually get the cash, or will SARS tax you when you're entitled to that income? It comes back to what we spoke about in accounting, cash basis versus accrual. Do you remember that? Okay, so if it's cash or an accrual, obviously it's going to differ because it's when do you receive the money, perhaps. Okay, so if you receive the money, like what are we going to do in terms of tax? When are we going to ascertain when that amount is taxable? Okay, cash or otherwise is the concept that's being covered there in terms of that case. Okay, Calden Hayes versus CIR. This is for own benefit. Okay, so income is income when you derive the benefit, not when someone else. Okay, so if someone else is deriving the benefit, should you be taxed on it? No, of course not. Okay, that wouldn't be fair to the person that is being taxed. Okay, if someone else is deriving the benefit, they should be taxed on it. They should pay tax on that amount. Does that make sense? Okay, and then another one is this one. Okay, which speaks to the definition of gross income. Okay, entitlement and does it accrue to you? Okay, so when is that entitlement created? When do you get that income? When is that income accruing to you as the individual? Okay, then that's another case. CIR versus people stores. Okay, these are all cases that have prominence in terms of the gross income definition. Okay, and those cases can be used in a theory question to discuss a certain point. Okay, you can use this case to motivate this point. You can use this case to motivate that point. You can use this case to motivate that point. Okay, there are others as well, and some of them you'll see a bit later on in other topics. Okay, this is a very important one, CIR versus FISA. Okay, courts use subjective and objective tests. Right, remember we said sometimes it's up to the judge. Okay, it's subjective. Okay, but once it's part of case law, it's set in stone and it will be precedent. Does that make sense?
Yeah.
All right, so the tree and the fruit principle is described and covered in the FISA case. Okay, so what is the tree and the fruit principle? Well, here's a tree and there's the fruit. What is income and what is capital? What would you say is income?
The fruit?
Yes. Why is the fruit income?
Because it's like operations or it's what's being produced.
Exactly. And then the tree is?
Capital.
Exactly. Right. And SARS uses this. And that obviously went to court. Okay, there was a dispute and now it's part of law. Okay, capital versus income. Okay, SARS might say it's income because they want to tax you more on it. the taxpayer is going to say it's capital because they want to pay less tax on it. Okay, what is SARS, or not SARS, well, actually, because of the case, what is SARS going to apply? SARS will apply the judgment from this case. They will look at the merits of the case and they would determine, is it the tree or is it the fruit? Okay, what is being used as the source? Okay, so are you selling trees or are you selling the fruits? Okay, so for example, the cow, okay, and the milk. Okay, what is actually happening? Are you selling the cows or are you selling the milk? That could affect the view on capital versus income. Okay, if you're a dairy farmer, the milk would be income. Okay, if you're a cattle farmer, a meat farmer, then cattle would be income. It depends on the tree and the fruits. Yeah, so it can get quite complex, but they're always going to apply this capital versus income discussion or debates. All right, does that make sense?
Yeah.
Okay, so tree and fruit, the tree and fruit principle is applied because we need to determine what is income. Income will always be the fruit. Okay, the tree will always be seen as capital. All right, it's always the case. All right, and these are the subjective tests that you need to apply. Okay, so what subjective tests can apply? Nature of the receipts, sale of the assets, intention, continuity, change of intention. Right, these are things that people will dispute. Okay, but these tests can be used to determine whether something is income or whether something is capital. Okay, remember the burden of proof. Who does the burden of proof lie with?
The person who's making a claim.
Yes, correct. Okay, so if you're claiming that the milk that you're selling is capital, you have to prove it. Okay, it's probably going to be very difficult to prove that if you're a dairy farmer and you're saying, well, I'm selling milk, it's capital. No. Okay, they're probably going to say, no, sorry, that doesn't make any sense. All right, because based on subjective tests, they could maybe look at what are you selling. Okay, and they could say, well, okay, you're selling the milk. The milk isn't the asset. The milk is the income. Okay, the asset would be the cow, potentially. Okay, objective tests, manner of acquisition. So did you buy the cow because of its milk or did you buy the cow because of its meat? Okay, did you want the meat or did you want the milk? That could determine capital versus income. Does that make sense?
Yeah.
Okay. Other objective tests, the period. Okay, when was the asset bought and how long is it held for? Okay, obviously, if you're buying it for the meat, okay, the time frame might be longer. If you're buying it for the milk, it's probably shorter. Okay, the manner of disposal. Okay, how did you sell? What did you sell? Nature of the disposal, reason of the receipts, legal nature of the transaction, accounting treatment. Okay, so why do you have subjective and objective tests? It's because of a discussion question. Okay, in the past, you could have got like a 10-mark question, potentially, looking at income and what is income, and when is it taxed and when is it not taxed, and is it capital or is it revenue? Okay, you'll see some of these in past papers. Okay, but as I said, I don't know how they're going to test this now because it's online. Are they just going to give you multiple choice and then it's just one or the other? Or are they actually going to want you to discuss it and to like actually apply it, discuss and look at the actual facts of the scenario? Okay, if it's a discussion question, they always give you a scenario, and it's normally a paragraph. They give you a paragraph, they describe a few things, and then you've got to decide capital or income. Okay, based on the merits of the case, inverted commas. Okay, the case study. Make sense? Happy with that? Okay. All right, and then the last slide in terms of theory here is looking at special inclusions and exemptions. Okay, so remember we spoke about what makes income income. Income is any amount that's going to be, going back to the definition, okay, any amount that's going to be cash or otherwise received by or accrued to during the year of assessment, excluding amounts of a capital nature. Okay, that means any amount. Right, but sometimes you have things that are capital in nature, but they're specifically included. For example, a lease. Okay, lease premiums and lease improvements. That relates to property. Property you could motivate as being capital. Do you agree?
Yeah.
But because SARS says it's a special inclusion, SARS says we don't care if it's capital, okay? Because it's a special inclusion, you must include it as part of your taxable income. See, these are special inclusions, meaning it's capital, but it must be included. Same with this. If I sell an asset, okay, SARS will say, yes, we know it's capital, but you still need to include it. It's a special inclusion. Dividends, insurance proceeds, recoupments, these are special inclusions. These special inclusions don't meet the definition of income, but they have to be included based on the rule of law. Does that make sense?
Yeah.
Okay, and then you have the opposite. Here at the bottom, here you have things that are income. These are income, but they're exempt. Okay, so dividends, interest, exempt. Okay, so dividends is included and then exempt. Right, you don't ever not show it. Okay, you have to show it. Right, because remember SARS wants to know everything. Right, so SARS wants to see the dividends and then they want to see you take it out. Okay, government grant, same thing. It's an exception to the rule. Okay, you remove it from taxable income. Make sense?
Yeah.
Okay, and then you've just got a note there about the exercises in the textbook. Let's go to the study guide and see if we've covered all the theory. All right, learning unit 4. This is looking at income for a business. Okay, notice it's a business. Here's that taxable income calculation. Income less deductions gives you that total, plus capital gain gives you taxable income. Notice, income is going to be looking at gross income, less exempt income. The definition and specific inclusions relate to gross income. This is a very good summary. Okay, it's a visual representation of this. Okay, you're looking at every line, but you're just looking at a different part of it. Does that make sense? Okay, right, so what has the textbook given you here? Let's have a look. Okay, obviously go through those prescribed textbook paragraphs. Okay, there's background. Okay, we've looked at background. We know what income is. We spoke about residence versus non-residence. We've looked at that. There's the note about the cause and the location. Okay, there's the note about gross income. Okay, remember, the definition of gross income is very important. That you need to study, that you need to know. Okay, you don't really have to need to study. You don't have to study it because if it's open book, if it's online, you can just reference it. Okay, it'll be better if you can just reference it. Before, if it was a closed book assessment, students would have to have memorized it. All right, and there's the definition. That you need to know. Okay, that's something worthwhile highlighting, circling. Okay, it's in your notes. Okay, we'll obviously use it when we get to test questions, okay, and questions that require discussion. Okay, these are discussion questions. They always come up. They're very, very popular. Okay, when is it income? When is it not? Right, those are the criteria points. Those bullet points need to be discussed in the discussion. So you should cover each and every one of them. So when I show you how to do past papers, okay, you literally just go to this, okay, you write it down, and then you need to discuss and motivate each and every one of these. Okay, either motivating for or against, depending on the question. Okay, so if it's a case study question, okay, you will pull out facts from the actual question and you'll use those facts to motivate all of these points. Okay, there's a note about specific inclusions. Okay, we spoke about those inclusions being incorporated or added to. Even though they don't specifically meet the definition, they're still going to be added and included. Okay, then what the textbook does, I see they've broken up each of those separate parts of the definition. Okay, notice the bullets, okay, they've broken it up into different sections. Okay, so the first section here, there's the first bullet. Amounts, capital or not. Okay, then they've covered that. Total amount, cash or otherwise, and they've covered that. Okay, there's the inland revenue butcher bros. See, there's the butcher bros. Okay, they've even summarized it here. This is good. Okay, in this court case, it was established that where an asset is received other than in cash, an ascertainable monetary value needs to be determined, and the onus is initially on the commissioner to prove that an amount will accrue to the taxpayer. Okay, so if you get an asset, will that be considered income?
No.
Yes, it can be cash or otherwise. Does that make sense?
If you get an asset,
So if someone gives you a gift, they give you a car. If they give you a car, you're going to say that's not income because it's a car and it's not money. Do you see that? What is SARS going to say? It's an amount. It can be cash or otherwise. It doesn't have to be cash. You can't say, well, I got a car. It's not cash, so it's not income. They're going to say, nope, 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 nope. Otherwise. So what is the car worth? What's the value of the car? Does that make sense?
yeah.
Okay. The burden of proof or the onus will be on the commissioner to determine the value that will accrue to the taxpayer. Right. So if they're saying that they're going to include the car, okay, the value can be disputed, and then they would have to have the burden of proof to say what the car would be worth. All right. But basically the point is, if we just keep it simple, is it money or otherwise? That's it. Okay, if it's money or otherwise, it's going to be included. It doesn't have to be money. It can be anything. It can be, maybe you get paid in assets, or you get, okay, here's a good question. If you get paid in vegetables, let's say you work at a farm. Okay, I work at a farm and I never get paid money, but I get paid in vegetables. When you submit your return, are you going to say, because I get paid in vegetables, I don't get paid, so I don't have any income? What is SARS going to say?
No, they're going to take the value off.
Exactly. They're going to say, sorry for you, it's not cash, but it's otherwise. I still want you to include that as part of income. Okay, you still get the benefits of deductions, allowances, etc., blah, blah, blah. But the point is, income must be income. Vegetables will still be income because you're paid in vegetables. It's paid in otherwise. Okay, does that make sense?
Yeah.
Okay. All right. If it's received by or accrued to or in favor of. Okay, here you have the Geldenhuis and the People Stores. Okay, so in the first one, Geldenhuis, received by a taxpayer if it is received by him or her for him or her or his or her own behalf and for his or her own benefit. Right, so if you're collecting something but it's for someone else, obviously it's not going to apply. If it's for your benefit, then it does apply. Does it make sense? Received by or accrued to or in favor of. Okay, People Stores, it was confirmed that the meaning accrued to is the amount that you will become entitled to. So is there entitlement? Question mark. If entitlement exists, income is income. Income must be included. Does that make sense?
So basically, like how we had accrued sales.
Not accrued sales. It's called credit sales. Credit sales.
Okay, so basically somebody owes me.
Yes, credit sales. So in other words, if you sell, so here's another example. You sell something on credit. Will you not show income? You will still have to show income because it's going to accrue to or in favor of you. Does that make sense?
Okay, so must I pay tax on money I haven't received yet?
100%. SARS will tax you on money that you haven't received, yes. Credit sales. Okay, you know credit sales from accounting?
Yeah.
Whether you receive that money or not, SARS doesn't care. A sale is a sale to SARS. SARS will tax you on the credit sales.
Okay.
Okay, that's just how they operate. Okay, remember, because it's part of.
Remember I forgot what it's called, but when you give them a discount to pay you back.
Yeah, that's different. Okay, that would be a discount that's received.
Will you get refunded your tax on that?
Okay, you haven't got there yet, but when you have deduction allowances, when you have credit sales, there is a portion that SARS will allow as a deduction. They call that a provision. So there is some benefit. Credit sales, there are deductions as well. But yeah, a sale is a sale. A sale is a sale. You make a sale, whether it's cash or credit, they're going to tax you on it. Okay, but you can have a provision for doubtful debts, or you can have bad debts, and you can have other things. Those other things will reduce it.
Okay.
Yeah, but there's no such thing as a rebate. Okay, when the sale occurs, remember, received to, accrued to, or in favor of, and it must be during the year of assessment. Okay, so if the sale happened during the year of assessment, it must be taxed during that year of assessment. If it falls outside the year of assessment, they will look at other scenarios. Okay, there is something called like prepaid expenses and stuff like that. Okay, that's a deduction. That's something different. But it must be during the year of assessment. Okay, is that all right? So that's the next bit. That was the received by accrued to, and that was during the year of assessment. Yes? No? Are we okay?
Yes.
Okay. Right, and then the last part of the definition. Okay, remember we spoke about the definition, those bullet points, excluding amounts of capital nature. Okay, here's the FISA case. Then you're going to be discussing this. Okay, is it the tree or is it the fruit? If it's the fruit, it's income. If it's the tree, it's capital. Okay, that was the debate. Right, for example, a manufacturing business, plant and equipment and machinery represents the tree, not the fruit. Okay, the capital nature is important because if it's not income, it's capital, then it's CGT. If it's income, it's gross income. Does that make sense?
Yes.
How do we determine whether something is capital or income in nature? You have to use subjective and objective tests. If it's subjective or objective, you've got all those different groups. Okay, this is in your notes actually. Okay, it's the same as what's here. Make sense?
Yes.
Okay, here's a case study. This is a good example. All right, so if you look at this scenario, Mint Limited has been carrying on a business of growing herbs for many years on the land it owns. The business, this is the only business of the company, only business, so obviously herbs. During the 2012 year of assessment, Mint bought an additional farm from a deceased estate at a favorable price. Obviously, the additional farm would be capital. At the time, the company did not need the additional land, but it decided to hold it until it was required for planting herbs at a later stage. Because of the economic recession, the company decided that it no longer required the land and sold the farm. Okay, so now they sold it. But remember the intention. What was the intention? The intention was not to buy and sell land. The intention was to buy land to make herbs. Does that make sense?
Yeah.
Okay, they sold the farm because the land is suitable for livestock farming. The amount was received in cash by Mint. Okay, so now you've got to go through those bullets. Go back to this page. Okay, total amount? Yes. Cash otherwise? Yes. Received by accrued to? Yes. During the year of assessment? Yes. Excluding amounts of capital nature? That's the point that you would debate. Okay, and that's probably what they've done. That's probably what they've done here. All right, let's see how they've done it. Yes, they have. Okay, they've used the subjective and objective test. They've even done it better. They've used this as well. Okay, they've incorporated this into the discussion. Okay, so you can see here, they're saying the manner of acquisition. Okay, it was bought on the market. Okay, the intention was to buy it to use it. There was investment, so it's capital. Did the intention change? The intention didn't change. Okay, the intention was always to use it rather than sell it. Does that make sense? But because they fell on difficult times, they had to sell it because they didn't have enough money. So selling it was done, okay, but not done with the intention of buying and selling property. Okay, they're not a property company. They're a farming company. They're a, what are they? They're a, yeah, that's the only business. They're not a real estate company. Does that make sense?
Yeah.
Okay, that's the change of intention. Period of which the asset was held, 8 years. Okay, obviously if it's 8 years, it's capital. Remember, it's long term. See, there's motivation why it's capital. Do you see that?
Yeah.
Okay, nature of the disposal. The asset was sold as an income producing asset. There's capital and nature. On the given facts, it can be argued that Mint Limited acquired the farm with the intention of developing it as a produce farm. Owing to the economic recession, however, it did not transpire. Since the land was surplus to the requirements, the decision was made to sell the property. The sale of the property amounted to a sale of a capital asset. There's the final judgment. See, there's your motivation. Okay, you had to go through all of that stuff to basically make a recommendation. Okay, and that's basically what you'll see in tests and exams. Recommend, what's this? Is this going to be seen as capital or is this going to be seen as income? It will be more likely to be seen as capital rather than income because I've motivated. Okay, does that make sense?
Yeah.
But that doesn't mean SARS will look at it the same way. SARS can still look at it as income, and if they disagree with you, then you can take them to court. Okay, and then the judge will decide. Does that make sense?
Yeah.
Okay, so just because you think it's capital doesn't mean SARS has to say it's capital. We're just looking at it from a basis of the facts. Okay, a matter like this can be taken to court. If SARS takes it to court, it's their burden of proof. Okay, if they disagree with you, if they say, no, sorry, we disagree, then they must prove that it's not true. Make sense?
Yeah.
Okay. All right, here's another example, but I see here they've given you amounts. 1,000, 1,050, 1,000. They're looking at gross income. It's a short example. And then they say determine giving reasons. See, there's the keyword, reasons. Whether this is received by will be gross income, whether received by is gross income, question mark. Again, what do? You go to this page, you write down those 5 bullet points, and you discuss each and every one of them. If you do that, you should get the same answer. Okay, these workers are very good. Okay, do I need to go through these or can I ask you to go through them? Yeah, well, you practice. Well, don't look at the solution. If I was you, I would write down those 5 points and I would look at this and I would see if I can motivate whether this is gross income or whether this is capital. Okay, and then I would check the answer. Does that make sense?
Yeah.
Okay, if you don't get the same answer with them or if you disagree, then we can discuss it next week if you need to. Okay, is that all right?
Okay. Yes.
Perfect. Okay, because I see these solutions are very good. They're quite detailed. It looks like they've improved it quite a bit because I see they've also included some of these cases. Before they never included them as much, but now I see it looks like they have. So this looks a bit better than some of the older examples. It looks quite good. Okay, and then they've even concluded as well. They have to conclude. Okay, there's the special inclusions. We spoke about that. Lease premiums, leasehold improvements. They're just describing why you should include them. Okay, I've never seen them ask about details like that. As long as you know that it's included or not, that's important. Okay, more special inclusions. Right, exemptions. Okay, we saw that in the notes. What's exempt? Taxpayers are exempt from tax, including level of government, institutions or bodies. Okay, these are taxpayers that are exempt. Okay, exempt means they don't have to pay tax. Okay, the types of income that's exempt: dividends, government grants. Okay, those are the same two that we saw earlier. And then, okay, there's a short little question here. And that's it. Then the wrap up. Looks like it. Okay. They've given you questions, but are there answers to these ones? Okay, not in this book. Let's check the other one. Let's check number 4. I think number 4 did have answers. I think it was only number 3 that didn't. and then you had to ask UNISA for the updated version. If I go to the bottom of this chapter 4, oh, not here as well. Unit 5, 6, and 7. Okay, so I think they've left out answers for the first 4 units. If I go further up, yeah, this is the questions. Okay, so yeah, with this particular document, this PDF. Okay, with this PDF, so the PDF covering 1, 2, Learning Unit 1, Learning Unit 2, Learning Unit 3, and Learning Unit 4. Okay, there's missing answers here. UNISA has not given you the answers, and you need to ask them for that. Okay.
I did ask them, and they sent me an email saying that it's at the back of the book.
Which book?
Actually get the.
Because this is the download that I have, and if I go to the back, I don't see it. It stops at page 71.
That's what I said.
Yeah, and if I look at this book, what is this book? Okay, this is this book, Learning Unit 5. Learning Unit 5, 6, and 7, I agree. The answers are there. Okay, at the back of the book, the answers are there. But it's not, it doesn't apply to the first book.
The exact email was, the solutions to all the questions in each learning unit can be found towards the back of the tutorial letter.
Okay, maybe there's a different tutorial letter then, but I've opened 3, I've opened 2. Let me open 1. Okay, this is number 1.
When I did send them an email, I did specify and say tutorial letter 102. So.
Maybe send them the actual file and then, oh, maybe here. No, this is assignment questions. Nope. Yeah, definitely send them the file. This is 102. 102 ends on page 71. There are no solutions here. You have to raise that. Maybe attach it to the discussion forum, attach it to the email, but tell them this is what I've downloaded from the My UNISA portal, and there are no solutions. It ends on page 71. There are no solutions here. Okay. I do agree. That was the case in the past, but not this year. Okay. I can open up an older version. And I have solutions, but as I said, that's an older version. See, here's the 102 from before. This is a 2018 file. Okay, the tutorial letter 2018. In this file, topic 1, topic 2, topic 3, topic 4. Self-assessment solutions, page 78. See, you don't have page 78. It stops at page 71 for you. Okay, it's here. If I go to theirs, where's topic 1.2? 1.2? No, this is 1.3. Yeah, here's 1.2. No, that's the other one. Yeah, this one. Okay, if I look at where's their contents page? Okay, see, their contents page doesn't have that. Look at their contents page. This is 2021. Do you see that? Okay, 2021. Right, there is no page 78 here. Missing answers. Have a look at 2018. Here's 2018. Do you see 2018? They're definitely missing answers here. See, 2018. There. That you don't have that in your textbook. You need to tell them that. Okay, send them the file. 2021. Tutorial letter 102 does not have any self-assessment answers here. It stops here. All right, even in their contents page, they have omitted it. All right, it's not even in their contents page. It's missing.